Hello everybody, I'm John. This is Strategic Investing, and we have a whole lot to go over here with Xtract One. We got Q1 earnings that were just released last week, and again, we have some record-breaking numbers here. And I do have to say, I did call this one because if you guys watched my video last week or a couple of weeks ago when they released their preliminary results, we were all kind of wondering why they did that. Why would you release preliminary results? They had never done that before. And I said in my video that my best guess is that they're going to change the way that they report their financials, and that is exactly what they did. And this is very important because the new format gives us a whole lot of new information, very key information that we didn't get before, specifically cost of revenue, gross margin, things like that are going to be really helpful in making accurate predictions about things like break even, profitability, and everything like that. So with that all said, let's jump right into it here. As always, I just want to go over some kind of key numbers right off the bat. So first of all, revenue here, platform revenue coming in at right around $3 million there. Great number, solid, up 600% year over year, and more importantly, 82% quarter over quarter. That is a growth rate that I think we'd all love to continue to see, and they are hinting that that will happen. Also, platform backlog reaching, if we go down here, platform backlog, where is it? Right here. 9.2, almost $9.3 million there for platform backlog. That is up 111% from just last quarter, just 3 months ago, okay? Phenomenal growth again here. And also, if we look at these signed agreements pending, they were actually able to continue to increase that. Only 200,000 more from the prior quarter, but again, they pulled a whole lot of that prior quarter's signed agreements pending into backlog, to revenue. So for them to be able to replenish that and even increase it while pulling all that through is a great sign to see. And it also speaks to what Peter was saying, which I'll touch on a little later, about the sales cycle increasing. Another thing to touch on here that's really important about these signed agreements pending, Karen mentioned on the earnings call that they expect to convert all of those agreements into backlog and revenue before the end of the year. She also mentioned that about 65% of the signed agreements pending were subscription. Now, we don't know whether that's 65% of the contracts themselves or the total dollar value of all of the contracts, but if we assume that it's the total value, then that would be about 6.9 million added to backlog and about 3.6 million added in upfront revenue. So what this all means is that if Xtract One were to not add any more contracts for the rest of the year, they just stop doing business, the next 3 quarters, they would still bring in close to $8 million in revenue simply from their existing contracts and their signed agreements pending. That is something to think about moving forward. Now, the next thing here, and this is really important, I want to touch on this change in the way that they report their financials, because this, I think, is going to be key in making some predictions here. So I'm just going to read this excerpt here really quickly from below here. So it says, on August 1st, the company changed its accounting for the presentation of its consolidated statements of loss and comprehensive loss from by nature to by function. The company made this change in presentation to provide more relevant financial information to facilitate peer benchmarking. The company has amended its prior year presentation to conform to the current year's presentation. Okay, this is really key, guys, here, because it really does give us a whole lot of new information and very key relevant information, as it says there, specifically around gross margin, cost of revenue, things like that. And I think another reason that they did this, which I laid out in my prior video when I explained that I thought they would do this, is probably to set themselves up to be very marketable to US investors and to be very ready when they want to uplist to the NASDAQ, because this is a lot more similar to the way that a lot of US companies that are listed on the NASDAQ are reporting. We see revenue here, right? We see that revenue divided into platform revenue and extract revenue. So we got the revenue segments, then we have the total revenue, then we have the cost of revenue broken down, and we get that gross profit number. And this is going to be really key in making our predictions around break-even profitability when they might reach those, right? Then we have kind of your standard expenses, selling, marketing, general and administrative, and research and development. Those are your operating expenses. Then you have other expenses and your loss, okay? So this is, again, much more in line with the format that most US companies, especially large US companies, are going to be reporting. So this is going to be much easier for not only US institutional, but also US retail investors to kind of really understand, and like they said before, also compare the company to their peers. And, they kind of want that comparison here because we're looking at some awesome margins, right? We're looking at about a 65% gross margin, which means that a large part, the majority, in fact, of this revenue is actually trickling down into the gross profit line, okay? And really what we're having to contend with then here is these operating expenses, right? And from, if you guys have been following Xtract One, especially if you've been following my earnings videos, those expenses have been relatively flat. In fact, aside from the last quarter, the 4 prior quarters, they've actually been falling, okay? So as long as they can continue to increase revenue and we see minimal expenses, really the only major expenses we'll probably see increase are the selling and marketing, right? That probably is the only expense that we see start to, and they kind of mentioned that on the earnings call, that we see start to increase. But really what we're looking at here is, as long as they can increase this revenue, they're going to overtake those expenses very quickly. So really, if you just kind of do some quick back of the napkin math, I'm going to do a video on this later because there's so much here to really go through. But if you just really kind of just think about it from a very simple, rough estimation, okay? You're looking at another 5 million in expenses here, okay, roughly. And so what you do is you just say, okay, well, how much revenue do they have to make based on their margins to make this gross profit exceed, 5 million, okay? And it's about 8 million or so in revenue that they would have to make to exceed those operating expenses. Now, obviously, as they've said, by the time that they, grow the business to that point, we're very likely going to see some of these lines increase a little bit. But again, that's just kind of your rough, baseline. They probably have to be making at the very least 8, maybe 9 million to get close to that break even. Again, that's 8 or 9 million per quarter, but we're looking at really rough numbers here. So just wanted to kind of put that out there for you guys. That's why these numbers are very important, because they actually allow us to do that type of math to really kind of make accurate predictions, actually, as far as when we think they might reach profitability, and also once they do reach profitability, what kind of PE ratio can we maybe be expecting, and how can we actually value the company. So this new way of reporting is extremely important from a whole variety of levels, and I just kind of want to get that across there. Another thing that I want to talk about here is, even though these expenses will likely increase, I believe that margin will increase as well. And you kind of have to look at the way that their contracts are structured in order to kind of come to that conclusion. So I've put together this little chart here. I know it's probably very small on your computer or your phone, especially if you're looking at this. But if you just kind of stick with me for a second here, what we're looking at is your standard contract. And I've just broken this down to make it really easy. Let's just assume that all Xtract One got was just one contract that was a $3 million subscription contract, okay? And it was a 3-year contract. So they're making every quarter $250,000, right? And that adds up in total for the 3 years to that $3 million, okay? And based on their current margins of 65%, we're looking at a cost of revenue around $87,000, which gives us a gross profit of around $162,000 per quarter. Now, what I'm going to get at here is something that Karen touched on the call, and that was how they actually report their costs. And what she said was, if they have an upfront contract, they recognize all of the revenue immediately, and they also associate all of the costs with that. That makes sense, right? But with the subscription, what they do, not only do they spread the revenue out over the life of that contract, they also spread the cost out over the life of that contract. So what we're seeing here is they're going to, like I have here, spread that cost out over the life of that contract. They're not going to say, okay, it costs us all of this money right up front, Q1, when we get that contract, and then all of the rest of that, money is just going to profit because we took the loss initially or something like that, right? What they're going to do is they're going to spread that out. Now, why this is important is because when we get to the point where that contract is over and they get to, an auto renew, because if the customer wants to continue using the product, they're going to have to renew that contract. And I don't know whether that's going to be renewed on an annual basis after that or whatnot. But the key part is here that all of their hardware cost and installation cost, things like that, all of that's already been recognized. The only cost that they're still really going to have going forward after the initial contract is really the upkeep, maintenance, support, and whatnot. The cost for them related to those services, which means if we look over here, and I'll just highlight this to make it easy to see, this is what we could be looking at, this sort of jump in profit margin, because now all of that hardware cost is gone. All of that's been recognized. And if you kind of look in, and again, I'll do another video on this later, but if you look at the way that they broke down and allocated different costs, it looks like hardware costs make up about half of the actual cost of revenue. So if you take off close to half of that, you're seeing margins jump from 65 to 84%. Now, we're not going to see that again like happen right away, because some of their contracts are always going to be new contracts that are going to have that lower, maybe 65 or so percent margin. And then as the life of the contract moves on, as we get these renewals in the contract, that's when we're going to see a lot of that revenue start to have a much higher associated margin. So we're going to see likely not just a shift from 65 to 84, but gradually over time, I think we're likely going to see a big shift from 65% towards this 84. Now, this 84, again, is just kind of a rough estimate right now. I'm going to do another video later to see exactly where those margins could go based on this new information, because again, all of this new information is going to be really, really helpful in making these calculations. But I just wanted to give you guys that kind of illustration as to what's going to happen and how these margins could actually really increase. Even though they look really good where they are, we could be looking at much higher margins later on. So I just wanted to kind of go over that quickly. Another thing that I want to talk about actually from the call itself that I think will also lead to an accelerated sales and probably accelerated margin as well is Peter mentioned that 20% of new bookings in the quarter were from existing customers, okay? This is really great because it shows that the customers, their current customers, really like the product and they want to buy more, okay? And we're going to see a much lower cost of customer acquisition, right, with this, because they're already existing customers. They aren't customers that Xtract has to go out and market to, do all these, trials and whatnot to prove to them that they actually do what they say they do. The customers already know, they're very happy with it, and they like it, and they're ordering more. So you can really kind of look at those sales, the 20% of the sales, as almost higher margin revenue, and actually very validating revenue here that we're getting by seeing that 20% increase. Another thing that's related to that he talked about on the call, and I think this is probably even more important, is he said that the sales cycle is actually increasing, or I should say decreasing. It's getting faster, okay? And one of the reasons he said that initially when, we were doing this, and any investor who's been with Xtract One, for the last couple of years knows this is a new product, right? And a lot of companies were hesitant. Peter made it clear that a lot of companies, especially stadiums and whatnot, would buy a couple lanes, really kind of try it out on an employee entrance, a VIP entrance. They didn't want to just cover the whole stadium initially. And so it's a very slow, process with small contracts that then maybe later on get built on, which we're seeing, with the 20% of new bookings being from existing customers. Well, now that they've kind of built up a little bit of a reputation, they have some very key, very good reference customers that they can go to. That sales cycle has really started to shorten, he's saying. One, because of those references, right? People trust them more. But also, you're seeing a lot of these reorders. You're seeing a lot of these customers that have already seen it in action. They don't really need all of that testing and validation at their own venue because they trust the product a lot more. It's not now this very new thing that's nobody tried. You got Madison Square Garden, Oakview Group, the TSA validation. You have a lot more to show a customer that is a lot of third-party stuff as well. It's not just their own marketing. It's all these other people saying, yeah, this company really does what they say they do. and that's really leading to a faster sales cycle. And hopefully that will allow us to see a lot of that signed agreements pending move even faster into revenue and backlog. So I think overall, that's kind of my main thoughts on this report. Really excited about the new way that they're going to do these financials. I am definitely going to be coming out with a video soon talking about profitability calculations and predictions, things like that, when we could see and what it's going to take for them to be break even, for them to be profitable. I'll also make kind of a little more in-depth video talking about those margins and what they're going to increase to and what we could be seeing there, and exactly why, maybe give some more better examples, some specific examples. But overall, great report again, record-breaking numbers again. They're talking about sales cycle getting even faster, so I think only good things ahead. Obviously, the stock is not reacting, I think, like a lot of us probably would. I think part of the reason for that, probably a large part, is because, the stock doesn't have a lot of visibility at the moment. And so most of the investors are already in the stock. They've built their position. It's going to take new investors to really come in and see the value and start buying to really push the stock up. And I think that's what, this new way of reporting is very likely going to do. Obviously, uplisting down the road will definitely do that. And we should see a lot of good things coming up. I think one last point also, we haven't really seen a whole lot of sell-off like we normally do with Xtract One going into the end of the year. A lot of people doing some tax loss harvesting. I think a sign of that, or a reason that we might not be seeing a lot of selling here, is because even though some people may be down in their position from the beginning of the year, they're really kind of hesitant to take their money out because they know in the near future we're going to see a lot of good things for Xtract One, and they don't want to be missing out on that just to capture a little bit of tax loss there. So that is definitely a good sign as well for kind of the investor base, the confidence in the company as well. We'll have to see, obviously, over the next couple of weeks that could change, but I think that's at least kind of a promising sign at the moment. Anyway, I hope you guys enjoyed this analysis here, found it helpful. Let me know in the comments below what you guys thought about this earnings, and other than that, have a great day. I will see you guys next time.